IMF versus BRICS, the battle that could redefine global money. A new war without guns, the fight for financial power. For over 70 years, global financial power has flowed in one direction, toward Washington. The International Monetary Fund, headquartered just steps from the White House, has acted as the world's financial firefighter, issuing rescue packages, setting monetary rules, and reinforcing the dominance of the US dollar. To many, it has symbolized order and stability. But to others, especially in the global south, it has come to represent dependency, control, and a system stacked in favor of the West. Now, a challenge is emerging. And it's not coming from Wall Street or Brussels. It's coming from the East and the South, from a coalition of rising economies that are no longer willing to play by the old rules. They call themselves BRICS: Brazil, Russia, India, China, and South Africa. Individually, they represent some of the world's largest and fastest growing economies. Together, they now account for over 40% of the world's population, nearly a third of global GDP, and an increasingly vocal demand for a new financial order, one that reflects today's power dynamics. Not the politics of 1945. But this isn't just about economics. It's about power. Power over currency. Power over credit. Power over who gets to make the rules and who must follow them. In recent years, BRICS has moved from rhetoric to action, establishing the new development bank as an alternative to the IMF and World Bank, launching cross-border payment systems to bypass the US-controlled SWIFT network, settling trade in local currencies to reduce dependence on the dollar, and even floating the idea of a common BRICS currency, possibly backed by commodities or digital infrastructure. Meanwhile, the West has responded, tightening sanctions, reinforcing the dollar's role in global trade, and strengthening institutional ties through the G7 and NATO. The message is clear: the old order isn't ready to give up its crown. But in a world shaken by pandemic, war, inflation, and geopolitical distrust, more countries are asking, is it time for a new system? This is not a war of tanks and missiles. It's a war of interest rates, credit lines, foreign reserves, and digital currencies. A silent battle waged in boardrooms, summits, and trading floors, but with global consequences. In this video, we'll explore how the IMF rose to shape the financial world, why BRICS is now leading the revolt, and what a two-system future might look like. We'll take you inside the biggest monetary shift since the end of the Bretton Woods era. The war for monetary power has begun, and it's one you can't afford to ignore. Chapter 1. Origins of Power: How the IMF Shaped Global Finance. To understand the growing monetary clash between the IMF and BRICS, we must first go back to where the IMF's power truly began, at a time when the world was broken and the future of global finance was uncertain. It was July 1944. Delegates from 44 allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their mission? To design a new economic order that would prevent the kind of chaos and conflict that had plunged the world into two devastating wars in less than 30 years. Out of this historic summit came two major institutions, the World Bank and the International Monetary Fund. The IMF's original purpose was straightforward, at least on paper. It was to promote international monetary cooperation, facilitate balanced growth of trade, and provide financial resources to countries facing short-term balance of payments problems. But the true significance of the IMF lay in something deeper. It would become the de facto overseer of global currency stability and, by extension, a gatekeeper to economic survival for many nations. At the core of the post-war system was the idea of fixed exchange rates, with currencies pegged to the US dollar, and the dollar itself backed by gold at $35 an ounce. This made the US dollar the anchor of the global monetary system. And because the IMF's largest shareholder was the United States, Washington wielded massive influence over global economic policy. This dollar-centric order worked, until it didn't. By the early 1970s, the United States was facing inflationary pressures and trade deficits. And gold reserves were no longer sufficient to back the soaring number of dollars in circulation. In 1971, President Richard Nixon effectively ended the gold standard. And the world transitioned into a system of floating exchange rates. Yet even without gold, the dollar remained dominant, and the IMF adapted quickly. Now, instead of simply stabilizing exchange rates, it focused more heavily on lending. When a country faced a currency crisis or couldn't pay its international debts, the IMF would step in with emergency loans. But these loans came at a price. This is where the IMF's true power began to show. Countries that accepted IMF help were required to implement sweeping economic reforms. These often included austerity measures, currency devaluation, deregulation, and the privatization of state assets. The rationale was that these policies would restore economic balance and create the conditions for long-term growth. But the lived experience in many countries was far more complex and painful. Latin America in the 1980s is a case in point. After borrowing heavily during the oil boom of the 1970s, countries like Mexico, Brazil, and Argentina were crushed by debt when interest rates soared and oil prices fell. The IMF intervened, but its programs led to widespread cuts in public spending, skyrocketing unemployment, and social unrest. Critics dubbed it the lost decade for Latin America. Similar stories unfolded in Asia during the 1997 financial crisis, in Eastern Europe after the fall of the Soviet Union, and in Africa throughout the 1980s and 1990s. Again and again, countries in crisis turned to the IMF, and again. The price of aid was economic pain. Supporters of the IMF argue that these reforms were necessary to stabilize faltering economies. They point out that the fund doesn't cause crises, it helps manage them. But detractors say the IMF's prescriptions often reflect Western ideological biases, emphasizing free markets and fiscal discipline over local realities. Worse, they argue that the fund imposes a one-size-fits-all model that undermines sovereignty. Another layer of IMF influence comes through its system of special drawing rights, SDRs, a reserve asset created in 1969 to supplement countries' official reserves. SDRs are not a currency per se, but a claim to currency held by IMF members. Their value is based on a basket of major currencies, including the US dollar, euro, yen, pound sterling, and more recently, the Chinese renminbi. While intended to provide liquidity and reduce dependency on any single national currency, SDRs are distributed based on IMF quotas, which means the wealthiest countries receive the largest share. This imbalance in voting power and resource allocation has become a persistent criticism of the IMF. The United States holds about 16.5% of IMF voting power, enough to veto major decisions. European countries also have significant sway. Meanwhile, many emerging and developing nations, despite representing the majority of the global population, have a far smaller voice. Reform has been slow. Proposals to increase the representation of developing countries have been made, but implementation is often blocked by the same dominant powers that control the system. Yet despite the criticism, the IMF remains one of the most powerful financial institutions in the world. It manages trillions in financial commitments, acts as a lender of last resort, and shapes policy in dozens of countries at any given time. From its Washington, D.C. headquarters, it monitors the pulse of the global economy and issues recommendations that can sway markets and alter the course of entire nations. In short, the IMF is not just a financial institution, it is a global economic force, built on the foundations of post-war American power and a belief in the primacy of liberalized, market-driven economics. For decades, there was no credible alternative. Nations might grumble, but they ultimately played by the rules. But now, for the first time in its history, the IMF faces a rising coalition that questions not just its policies, but the legitimacy of the system it upholds. That coalition is BRICS. And it's not just challenging the IMF's power, it's rewriting the rules of the global financial game. Chapter 2: The Rise of BRICS, Why Emerging Economies Are Fighting Back. For decades, the international monetary system has operated as a hierarchy, with the International Monetary Fund and Western financial institutions at the top. And emerging economies often left to adapt to rules they didn't write. But in recent years, a powerful new alliance has emerged, determined to change that. This alliance is known as BRICS: Brazil, Russia, India, China, and South Africa. The origins of BRICS weren't political. In fact, the term was coined in 2001 by economist Jim O'Neill at Goldman Sachs. He used it to describe a group of fast-growing economies that, he predicted, would reshape global growth. At the time, it was just an investment category, a catchy acronym to group rising markets. But by 2009, BRIC had evolved into something more meaningful. In the wake of the global financial crisis, which exposed the fragility of Western-led finance, Brazil, Russia, India, and China held their first formal summit. A year later, South Africa joined, turning BRIC into BRICS. Together, they began advocating for a fairer, more inclusive global financial system, one that reflects the realities of a multipolar world. The case they make is hard to ignore. BRICS countries account for over 40% of the world's population and around 30% of global GDP, yet their influence at institutions like the IMF remains disproportionately low. The United States, for example, holds about 16.5% of voting power at the IMF, enough to unilaterally veto key decisions. BRICS nations combined, despite their demographic and economic weight, don't come close. For these countries, the imbalance isn't just symbolic. It's structural. IMF lending policies, conditionalities, and even reserve allocations through special drawing rights, SDRs, often favor the developed world. When crises hit, it's usually developing nations that must accept harsh economic reforms to receive assistance, while developed countries often avoid the same scrutiny or consequences. This frustration gave rise to a simple but radical idea: if the system won't change from within, then create an alternative from the outside. In 2015, BRICS launched the new development bank, NDB, headquartered in Shanghai. The NDB's goal is to fund infrastructure and sustainable development projects in emerging markets, free from the political strings often attached to loans from the IMF or World Bank. Unlike Western institutions, the NDB gives equal voting power to each member country, regardless of GDP. It's a model built on partnership, not hierarchy. But perhaps more significant is the Contingent Reserve Arrangement, CRA, a $100 billion pool designed to provide short-term liquidity support to BRICS nations during times of financial stress. The CRA functions as a financial safety net, allowing member states to defend their currencies or stabilize markets without turning to the IMF. These institutions represent more than financial tools, they are symbols of sovereignty. For countries like Russia and China, which have long sought to reduce their dependency on Western financial systems, BRICS offers a strategic platform to promote economic independence. The political dimensions of BRICS have also expanded. In 2023, the bloc made a historic move by inviting 6 new members: Saudi Arabia, Iran, Egypt, Ethiopia, the United Arab Emirates, and Argentina. This expansion sent shockwaves through geopolitical circles. With these additions, BRICS now include some of the world's largest energy producers and fastest-growing economies. This move wasn't just about size, it was about influence. By bringing together oil-rich Gulf states with commodity powerhouses and industrial giants, BRICS is reshaping the foundation of global trade and finance. Discussions have accelerated around creating a common BRICS currency, potentially backed by gold, oil, or a basket of member currencies. If realized, such a currency could challenge the dominance of the US dollar in global settlements. Why does this matter? Because the US Dollar isn't just a currency, it's a tool of geopolitical power. Countries that trade or borrow in dollars are often vulnerable to US interest rate hikes, capital flight, or sanctions. This became painfully clear when the US and its allies froze Russia's foreign reserves in response to the Ukraine invasion. For many non-Western nations, this was a wake-up call. Financial sovereignty could no longer be taken for granted. BRICS has responded with ambition. China and Brazil have agreed to settle trade in their own currencies. India and Russia now conduct energy deals in rupees. The United Arab Emirates is exploring oil trades priced in Chinese yuan. And Russia, isolated from the Western financial system, has accelerated efforts to develop its own financial messaging infrastructure, alternative to SWIFT. These moves are not just economic, they are deeply political. BRICS is presenting itself as a voice for the global South, pushing back against what it sees as the monopoly of Western financial governance. It argues that development models should be context-specific, not dictated by institutions thousands of miles away with vastly different priorities. Still, BRICS faces real challenges. Its members are diverse in language, culture, governance, and interests. China and India, for instance, have ongoing border disputes and strategic rivalries. Brazil and South Africa have vastly different economic models. Decision-making within BRICS can be slow, and ambitions often exceed implementation. Yet despite these internal differences, BRICS is unified by one powerful idea: the global financial system should no longer be defined by the past. For the first time since Bretton Woods, there's a serious effort to reimagine how money moves, how power is distributed, and who gets to write the rules. The IMF, once an uncontested leader, now finds itself facing a rival bloc with its own vision, and increasingly, with its own institutions. The question now is no longer whether BRICS will challenge the old system. It's whether the old system can survive the challenge. Chapter 3: Currency Wars, Dollar Dominance versus De-Dollarization. For nearly 8 decades, the US dollar has reigned supreme in global finance. It is the world's most trusted reserve currency, the primary medium for international trade, and the anchor for the pricing of critical commodities like oil, gas, and wheat. But behind that dominance lies a mounting resistance, a push by nations, especially within the BRICS bloc, to break free from the dollar's grip. Welcome to the modern-day currency war, a high-stakes battle between the entrenched power of the dollar and the rising wave of de-dollarization. To understand the scale of the dollar's dominance, consider this: as of 2023, over 58% of global foreign exchange reserves were held in US dollars. Around 90% of global forex transactions involved the greenback. Most international debt is denominated in dollars. From developing countries borrowing to fund infrastructure to multinational corporations hedging risk, the dollar is everywhere. This widespread use gives the United States enormous advantages. It lowers borrowing costs at home, allows the US to run large trade deficits without immediate consequence, and most critically, gives Washington immense geopolitical leverage. When the US imposes sanctions or freezes dollar assets, it can effectively cut a country off from the global economy. That leverage came into sharp focus in 2022, when the US and its allies sanctioned Russia following the invasion of Ukraine. Among the harshest measures was freezing over $300 billion in Russian central bank reserves, most of it held in dollars or dollar-linked assets. Russia was also removed from SWIFT, the global messaging system used by banks to process cross-border payments. The message to the world was clear: your dollar assets are only safe if you're on good terms with Washington. For many countries, especially those with strained relationships with the West, this was a wake-up call. The dollar had become not just a tool of commerce, but a weapon of control. And that realization sparked a rush to diversify away from it. Leading the charge is China. Over the past decade, Beijing has signed dozens of bilateral currency swap agreements, allowing its trading partners to settle transactions in renminbi, RMB, instead of dollars. countries like Pakistan, Argentina, and even France have conducted RMB-denominated trades. China has also launched the Cross-Border Interbank Payment System (CIPS) as a potential alternative to SWIFT, aiming to reduce reliance on Western financial infrastructure. Russia, too, has accelerated its de-dollarization efforts. Following the 2022 sanctions, Moscow began demanding payment for oil and gas exports in rubles or other non-dollar currencies. It deepened financial ties with China and India, settling trade in yuan and rupees. In parallel, it expanded use of its own payment system, SPFS, to facilitate non-dollar settlements. India has joined the trend, settling deals with Russia in rupees and promoting its Unified Payments Interface, UPI, internationally. Brazil has agreed with China to conduct bilateral trade in yuan. Even the Middle East, a region long anchored in a petrodollar system, is showing signs of shift. The UAE and Saudi Arabia have participated in yuan-settled oil contracts on the Shanghai Petroleum and Natural Gas Exchange. At the core of these shifts is one goal: reduce vulnerability to dollar-based sanctions and monetary shocks stemming from US interest rate changes. In a world of rising geopolitical tensions, the ability to insulate your economy from American pressure is increasingly seen as strategic self-defense. But can these efforts really dethrone the dollar? In the short term, the answer is not likely. The dollar retains enormous structural advantages. It operates within the deepest and most liquid financial markets in the world. Investors trust US institutions, contracts, and the rule of law. There is no single alternative currency today that offers the scale, transparency, and stability of the dollar. Moreover, while BRICS countries are pushing for de-dollarization, they face their own challenges. The Chinese yuan is not fully convertible. The Indian rupee has limited acceptance outside of South Asia. The Russian ruble is highly volatile. Even if these currencies are used more in regional trade, they struggle to gain trust as global stores of value. This is why some in the BRICS community have floated more ambitious ideas. One proposal is the creation of a common BRICS currency, a shared unit possibly backed by a basket of member currencies or even commodities like gold, oil, or rare earth metals. Such a currency could, in theory, reduce exchange rate volatility and serve as an alternative for trade settlement. Others advocate for a digital currency issued by a BRICS monetary authority, allowing member states to transact on a shared blockchain infrastructure. China's progress with its digital yuan, ECNY, has already set the stage. The goal? Bypass the US financial system entirely, no SWIFT, no Fed, no dollar intermediaries. The IMF, watching these developments closely, has struck a cautious tone. It has warned against financial fragmentation and currency blocs that could undermine global cooperation. At the same time, it has acknowledged that the dollar's dominance may slowly erode as alternatives mature. In response, the IMF has advocated for increased use of special drawing rights, SDRs, as a neutral reserve asset and has begun integrating more voices from emerging economies. But it knows its influence is tied to the dollar's power, and that power is no longer absolute. The global monetary map is shifting. What once looked like a rigid dollar-centric world now resembles a growing patchwork of competing systems. Nations are experimenting with bilateral trade in local currencies, building parallel payment networks, and stacking gold reserves at the fastest pace in decades. We are not witnessing the end of the dollar, but we are witnessing the end of its unchallenged supremacy. For the first time since Bretton Woods, a genuine contest over the future of global money is underway. Not through force, but through finance. And the outcome will reshape not just currencies, but the geopolitical order itself. Chapter 4. What's next? A bipolar financial world? The world is changing fast. For decades, there was only one dominant system, a Western-led financial order centered around the US dollar, the IMF, and global institutions rooted in the post-World War II vision of stability and cooperation. But as BRICS expands and de-dollarization accelerates, the world is inching closer to a bipolar financial reality, two competing systems with distinct rules, currencies, and centers of gravity. The first system is familiar. It's built around the US dollar, enforced by institutions like the IMF, World Bank, SWIFT, and global credit markets. It operates on the principles of open capital flows, market-driven currencies, and deeply integrated financial institutions, mostly headquartered in the West. This is the system that financed decades of globalization, enabled rapid trade expansion, and set the standards for monetary cooperation. The second system is still under construction. Led by BRICS nations and amplified by their expanding partnerships, this alternative system envisions a more decentralized, multipolar financial architecture. One that reduces dependency on the dollar, embraces regional currencies, and creates new institutions like the new Development Bank and Contingent Reserve Arrangement. Its ultimate goal? Redefining sovereignty in global finance. As these systems take shape, the global economy is already feeling the effects of fragmentation. Take trade settlements, for example. In just the past 2 years, there has been a surge in bilateral trade agreements bypassing the dollar. China and Brazil now settle deals in yuan and reais. India and Russia trade energy in rupees and rubles. The Middle East, once a pillar of the petrodollar system, is experimenting with non-dollar oil contracts. Meanwhile, central banks from Turkey to Thailand are diversifying their reserves into gold, yuan, and euros. Payment networks are also diverging. SWIFT remains dominant, but alternatives like CIPS, China, SPFS, Russia, and proposed BRICS-linked digital payment systems are slowly gaining traction. These platforms are designed not just to transfer money, but to reduce exposure to US surveillance and sanctions. It's a slow, methodical separation, one transaction at a time. Monetary policy, too, is becoming less coordinated. During past global crises, countries looked to the US Federal Reserve or IMF for guidance and support. Today, emerging economies are more likely to pursue localized monetary strategies, guided by domestic inflation and geopolitical pressures, rather than Washington's interest rate cycle. The result is a world of parallel responses to global problems. Inflation, debt, climate finance, and food security are all being addressed through separate blocs, each with its own toolkit and philosophy. The IMF still offers conditional loans tied to austerity and reform. The BRICS Bank emphasizes infrastructure, energy, and resilience, often without political conditions. This split is not just economic. It's ideological. The Western system emphasizes liberal economic principles, transparency, and rule of law, ideals often linked to political liberalism and democratic governance. The emerging BRICS-aligned system leans toward state sovereignty, non-interference, and development-focused finance. It's less interested in lecturing governments and more concerned with reshaping global power dynamics. So what does a bipolar financial world look like in practice? First, expect greater volatility. As currency blocks form and capital flows become more segmented, financial markets may become less predictable. Investors will need to navigate competing standards, shifting exchange rates, and geopolitical risk tied to which system a country aligns with. Second, developing countries may gain more leverage. With two systems offering different types of support, nations in Africa, Southeast Asia, and Latin America could play one bloc against the other, negotiating better terms, more aid, or infrastructure funding without strict conditionalities. This dynamic, if managed well, could lead to more autonomy and bargaining power for the global South. Third, technological competition will intensify. Digital currencies, blockchain-based settlement platforms, and central bank digital currencies, CBDCs, will become new battlegrounds. China's digital yuan is already operational in pilot form. The US is studying a digital dollar. India, Brazil, and Russia are also experimenting with digital currency platforms. In a bipolar world, tech infrastructure will be as strategic as tanks or pipelines. Fourth, the dollar's role will shrink slowly, but steadily. It may remain the world's top reserve and trade currency for years to come, but its monopoly is fading. As more countries build alternatives, the world will see less dollar-denominated trade, fewer dollar reserves, and a reduced ability for the US to use the currency as a tool of foreign policy. But this is not just about decline or rivalry. It's about transition. We're entering a world where two systems will coexist, compete, and sometimes cooperate. They may create financial redundancy, but also resilience. In some areas, they'll clash, particularly over sanctions, debt restructuring, and digital currency rules. In others, they'll interoperate, allowing countries to navigate both spheres depending on their interests. Ultimately, this new era will demand more sophistication from policymakers, more adaptability from businesses, and more awareness from global citizens. The rules of money are changing, and as the dollar's once unshakable supremacy gives way to a more fragmented reality, the future will not be written by one nation or bloc, but shaped by the tensions and negotiations between many. In a world where the IMF and BRICS now represent rival visions of economic order, we're witnessing the dawn of a new chapter in global finance. It's not unipolar. It's not yet multipolar. It is, undeniably, bipolar. Conclusion: the battle for monetary power has only just begun. As we've explored in this video, the world of global finance is undergoing a quiet, yet seismic transformation. For decades, the International Monetary Fund stood as the architect of the post-war financial order, writing the rules, managing crises, and reinforcing the dominance of the US dollar. It was a system that promised stability, but often delivered inequality and dependence, especially for emerging economies. Then came BRICS. Once just an investment buzzword, BRICS has evolved into a serious geopolitical and financial alliance. These nations, Brazil, Russia, India, China, and South Africa, have grown tired of playing by rules they didn't create. Their response has been bold, creating alternative institutions, promoting local currency trade, building their own payment networks, and even proposing a common BRICS currency. With the inclusion of new members like Saudi Arabia, Iran, and the UAE, their influence is expanding beyond the economic into strategic territory. At the heart of this story is the US dollar. For nearly 80 years, it has been the world's default currency, the foundation of trade, reserves, and power. But its status is now under scrutiny. As more countries push to de-dollarize, settle trade in local currencies, and build financial alliances outside of Washington's reach, the era of uncontested dollar dominance appears to be drawing to a close. So what comes next? We're not heading toward a global collapse, but we are moving toward a divided financial world, one where two systems operate side by side. One led by the West, built on legacy institutions and dollar-based finance. Another led by emerging powers, built on new platforms, currencies, and ideologies. This bipolar order won't emerge overnight. It will be uneven, messy, and full of contradictions. Countries may engage with both systems at once. Financial flows may overlap. Even the IMF and BRICS may find themselves cooperating in moments of global crisis. But the direction is clear: the unipolar moment is over. This isn't just a shift in monetary systems, it's a shift in how the world defines economic sovereignty, trust, and power. As we witness this monetary transformation unfold, the biggest question isn't whether BRICS can fully replace the IMF, or whether the dollar will collapse. The real question is, who will write the rules of the next financial era? Will it be a single dominant power, or a diverse coalition of voices? Will it be built for resilience and fairness, or competition and exclusion? One thing is certain: the future of money will shape the future of everything: trade, security, inequality, even climate action. The stakes could not be higher. That's why it's more important than ever to stay informed. Think critically and understand the deeper forces driving these global shifts. If you found this video insightful, help us spread awareness by liking, sharing, and subscribing to Money Minded. We dive deep into global finance, monetary trends, and the hidden power struggles shaping our world, always with a clear, balanced, and independent perspective. Let us know in the comments. Do you believe a BRICS-led system can truly rival the dollar-dominated order? Or is this just another phase of global realignment? We'd love to hear your thoughts. Until next time, stay curious, stay critical, and stay money-minded.